Hi, it's June 13, 2020, Saturday. It's about 10 p.m. in the evening. Because of what has happened over the past week, whereby markets have actually rallied back to their year to date highs, and after that fell. I think it's important to give an outlook on what we think is going to happen next, especially as some of the indicators that we're looking at suggest to us that things could be a little bit more volatile in the coming weeks. First and foremost, as usual, any reference to performance in this update, again, please take it as backward looking. In terms of future performance, there's no guarantee. If you would like to actually look into your investment portfolio or get any advice, please seek out the advice of your licensed financial advisor from Financial Alliance in Singapore or FA Advisory in Malaysia. Okay, I think before we continue further, let's just do a quick recap on some of the calls we've been making over the past couple of weeks. We had actually monitored the COVID situation probably in January, and then after that got a bit worried. And increasingly, as we understood the situation, on February the 6th, wrote a report about the potential risk from a shutdown. And it was on February 24th that we actually started this channel on YouTube, and one of the first, or actually the very first sessions or episode was basically explaining what the shutdown risk is all about. And markets actually fell from then onwards. And on March 24th, we actually called for a temporary bottom in the markets, saying that the markets would probably rebound, and the markets have rebounded. Note that we consider it to be temporary. May 16, we actually gave an update. What I'll do is I'd like to share with you the update that we gave on May 16. This is where we actually also came out with an episode called Market at a Critical Juncture. Okay. So basically, from a technical perspective, what we believe is this particular region itself, which is made up of the previous high here, this particular line, so that's a key resistance. The 3000 level is a key resistance because of the psychological nature of it. And basically, if you look at a high over here and you extend it over here, that's about 3130. So this region itself, we would deem it as a resistance region, which is very important for bulls to actually take it out in order to swing the rally, or in order for the rally to continue much higher. The failure to actually pass this resistance region actually will hamper bulls, and i.e. Put the buyers towards a downside move actually from here. So this is very critical, and I think we've reached a point whereby this needs to be taken out ASAP. Otherwise, momentum will start growing to the downside, and that's why we're in this chapter, in this episode, we're saying over the next week or so, we have reached a very critical juncture. Things ought to be happening now, i.e. either it goes in our direction, or even if it doesn't go in our direction, it's going to happen probably in the next 1 week. Right, so on May 16, almost a month ago, we mentioned that in episode number 12, and thereafter the markets actually rallied very strongly by about 16%, not in the direction that we expected, but as we mentioned, it was about to swing either way, and it proved that it actually wanted to go higher. Bulls actually led it higher, so it actually went past the resistance region and therefore set up a move all the way back to what we call the previous highs that we saw in February. Okay, so we're really at that point now, where we are at the February highs. Another technical indicator, or rather that region itself that I mentioned in the previous slide, it was really a region where a lot of people were looking at in terms of technicals, in terms of the 200-day moving average, and so on. This is important to understand because, as we know, these kind of resistance regions, when they're very strong, there are a lot of stops behind it. There are a lot of people who are sitting by the sideline. As this region gives way, these people will actually jump back on again because it's a technical indicator indication that the resistance has been broken and therefore a new uplift is underway. And so true enough, we've reached what we call back to the highs of February. The smart money, the quant money, if you look at the headlines, Druckenmiller, who just last month had mentioned the risk rewards weren't very good. Bank of America in April mentioned that they were slashing their S&P targets. So all these guys have actually reverted now to the upside in terms of Druckenmiller saying he was far too cautious. Bank of America now saying sorry, we've missed out the recent rally because of our forecast of being too bearish. So again, the smart money does suggest that they're back in again. They've turned bullish again, or at least they've turned neutral at the very least in terms of this rally. So that has helped to propel the rally higher. And there's also this a wave of retail investors that have come in. If you look at the chart here provided by so-called Robinhood data. Robinhood is a platform in the US which many retail players actually open up accounts and trade the markets via Robinhood. Basically, the number of account openings over the past couple of weeks to past few months have been tremendous. It's been 3 or 4 times more the usual rate. These are people who are now at home under lockdown. They have a bit of time on their hands and they start to trade the markets probably for the first time. So this new wave of retail players are also considered to be part and parcel of the reason why the markets have gone higher over the past couple of weeks. The focus has been, not surprisingly, on the technology and also the healthcare sector. Many other sectors still remain roughly in the doldrums, sideways and such, but the two obvious one, of course, is technology and healthcare. And we all know technology is basically driven by the FANG stock plus Microsoft, making up roughly about 40% of the Nasdaq and 20% of the S&P 500. So huge concentration in these stocks. Huge move in the indices because of this high concentration on a handful of stocks. And again, with the huge participation of retail investors, we have some strange phenomena going on. We have a bunch of companies whom are either on the verge of bankruptcy or even have announced their bankruptcy, coming back to life, so to say. As you can see from this table, people like JC Penney, Whiting Petroleum, all these guys have just rallied so strongly over the past couple of weeks. Where a very strong indication of speculative participation, very much tied to retail investors. I think the one that I like very much is that of Hertz. I think everybody's been following this, how Hertz have started out in the year above $20, and by May 22nd, what happened was Hertz actually declared bankruptcy, Chapter 11 in the US. Its stock fell from $2.84 all the way down to 56 cents on May 26. But lo and behold, by June the 8th, it was up to $5.53, basically almost increasing near to about 1,000% over this short period of time, which is made more unbelievable by the fact that it is a company under bankruptcy. So again, people have called it a zombie rally, zombie companies which really come back from the dead, but it is really indicative of investors who are very speculative in nature, retail and so on. Okay, so basically, by and large, what we've seen is we've seen the market move up. Okay, no doubt about it. We've seen it in the indices. Indices have moved up. The smart money has indicated that they are now more bullish. The so-called retail money very clearly is in the markets. We have indication from all these bankruptcy companies being played up and so on and so forth. Okay, but when you really look under the hood and you look at some of the financial indicators, so financial indicators are different from macroeconomic indicators like CPI or GDP. So financial indicators, you could lump them into what we call indicators that point to derivatives, or you derive it from derivative markets and such. So one of them probably is, for example, the put call ratio, the number of longs, the net flows, and these kind of things. Yeah. So when we look really into the under the hood into these financial indicators, I would ask you to go and look into this particular blog itself, which is very interesting, from macro charts. You see that the indicators, these financial indicators, suggest that the markets are quite long, okay, and overly long in certain views, which means that we have from fund managers, mutual funds, all the way to speculators, all the way to maybe quants, and even active fund managers, all being very long on the market. When the market is very long and the market reaches a point of strong resistance, which is the previous high of the year, you'll find that it's very difficult for the markets to actually try and overcome that historical high, or rather high of the year, because it's very much like you've approached a major resistance, and you really need the firepower to get over that resistance. But if you are really long, there's really no way you're going to overcome that resistance. You need to be a bit short in order for you, or not even short, you need to be a bit neutral in order for you to pile up on longs, or even i.e. Buy some more in order to overcome that actual resistance. So I think the major thing that we saw late last week when the markets pulled back sharply was the inability to add on to buys, or at least add on to their longs, because they were just already overly long. On the technical indicators, what we're seeing is on the hourly, 4-hourly, daily, weekly, and even on the monthly charts, there are red flags already showing up, signaling that potentially we could see a period of volatility, lower markets in the weeks ahead. Just to point out, on the 4-hour chart, after closing on Friday itself, we have it breaking what we call a trend line, which has existed since the low in March. On the daily chart itself, there was a gap down, and if you look back in the February decline, it showed a very similar type of gap before moving all the way down. On the weekly charts, what we have something called like an engulfing pattern, whereby the whole week itself totally wiped out the previous week's strong gains, and that is a very strong indication of a market that is very, very bearish, or very, very weak. And on the monthly chart, although the monthly chart, I have to say, hasn't closed yet, because a monthly chart is supposed to close only at the end of the month, and we're just halfway there. Already, if you look at the chart patterns, where we have what we call very long tails at the top, these are the tails that you really don't want them to appear at the end of, or they tend to appear at the end of a strong or a long trend, uptrend, so to say, or even downtrend. So in the uptrend that we've seen since 2009, if I just expand this particular portion here, you'll see that actually the tails have been very long during this past few months, at the tops here. So basically what that indicates is that the markets tried to move higher, but they were beaten back by bears, profit taking, whatever the case is. So these are really bearish indicators. It doesn't tell us how far it goes at this particular point, but just warns us that there could be a reversal, and when it shows up on all these time frames, it's something to pay attention to. Okay. So all in all, has our view changed? And the answer is no. Those of you who have been following what I've been putting out, you'll know that the odds I've attached to the view is 70% to the downside, 30% to the upside. When you look at things from a 10 feet view, standing right in front of this particular rebound, it's very impressive. I have to give it to the markets. It does look like a V-shaped recovery. You know, everything about it tells you that markets are bullish. But however, if you take 30,000 steps behind, or look at it from a 30,000 feet view, like I do, what you see is basically you see a market that has gone up over the past 10 years very, very strongly, a market which one has to ask oneself, can it actually go and return back to the trajectory based on this dotted line? Or does the future really hold a lot of uncertainties, so much so that we are really at the end of the cycle, and this really is the first domino potentially to bring the markets down from here after this great 10-year run in the markets? Okay. So what I believe is this week itself, the return back to the highs that we saw in February, the failure to take it out, basically what's going to happen over the next couple of weeks is going to really set the tone for the rest of 2020. Okay, so that's my call for the next couple of weeks. It's going to be quite critical. The scenario number one basically is if the markets can just really run through, hop over the previous highs of 3393, set back in early this year in February, and cut through that resistance, that major resistance level, very much like how a knife cuts through butter, then it would indicate to me that this is really a market that is extremely bullish. Albeit it would also indicate to me that it's something which you have to be very careful about, because it does look like it's very euphoric, and we all know that based on sentiment, when markets are euphoric, you have to be very careful, because things could just turn almost immediately. Okay, but it would be very bullish if the markets just took out 3393, for example, on the S&P 500. Okay, if I'm a bull, basically I would actually be more comfortable if the markets consolidated. If the markets consolidated at these levels, retraced, found a temporary bottom somewhere, maybe near 3000, 2009, and then started to move sideways and eventually broke up or broke higher, then I think I would actually be more comfortable as a bull rather than the first scenario. Because the first scenario I don't think is sustainable. The second scenario is more a sustainable kind of scenario. And the second scenario basically reminds me of 2016, when we did see, after a long run up, the markets actually pulled back and then tried again to retake the highs, didn't manage to, retrace back again, started to form what we call consolidation, and then tried again, and then after that eventually broke through after about 9 months after its first attempt, and then took a short breather or rest above the former resistance turn support, and then carried on in what we call a very strong up leg in 2017 and all the way into 2018. Okay, so basically if I were a bull, then this would be the best scenario in my case. However, like I mentioned, I'm still biased more to the downside. So basically I think what will happen is this, just before I forget, the second scenario, the outcome or the analysis of the second scenario would be, during this consolidation period, news wise, what you would find is things that are bearish in nature in terms of the virus, in terms of the economy, it's being offset, or rather it's probably not as bad as one would expect, and that's why you see this consolidation and people willing to come in to buy the dips, because news is not as bad as expected. Okay, but my scenario, which I think will happen, or at least that's the bias I believe in, is that there will be an underestimation of the risk, and I've highlighted this in previous videos. So the underestimation of these risks, whether it's economic risk, whether it's market risk, whether it's COVID-19 risk, and so on and so forth, that will lead the market to adjust lower, because again, reality is much worse than what the market has discounted. Okay, so I think it's going to break downwards from here, but again, this is the third scenario of three scenarios. My bias is to the downside. It's left to be seen. I think we're going to just have to monitor the markets in terms of its price patterns. So first thing first, let's see whether the markets can form a consolidation, a short consolidation. If it can't, then basically that third scenario basically comes into the picture. Okay, and I'll be very surprised if it turns out to be the first scenario, to be honest with you. Okay, so hopefully that would help you in terms of looking forward over the next few weeks in terms of what the markets could actually be doing. If you like this particular video, do subscribe to our YouTube channel under Financial Alliance. If you like this particular video, do give it a thumbs up. I would appreciate it very much. So I hope to see you again in future videos. Thank you.